Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class of strategic financial management, we will continue with the topic interest rate risk management or interest rate derivatives, and this is the third lecture on interest rate derivatives. Now in this class we are going to begin with something wonderful. Concept number 10, that is concept of interest rate swaps. Interest rate swaps are also known as plain vanilla swaps or generic swaps. So what are exactly these interest rate swaps? First of all, these are yet other form of derivatives. A derivative contract where the underlying is the interest rate. Now, something very important. If you can recollect, in the previous chapter, that is set of two chapters back to back that you have learnt, derivatives part 1 and derivatives part 2, we have covered three basic forms of derivatives: forwards, futures and options. We have just talked about yet another form of derivative, that is swap, but we have never understood yet what is a swap. Swap can be primarily of two types. One, which is called interest rate swap or plain vanilla swap. One could be a flavored swap where not just the interest but even the principals get swapped, and that is the later part of discussion that will be classified as currency swaps. So currency swap is just an upgraded version of interest rate swap. Here in interest rate swap only the interest would swap, and under currency swap not only the interest but even the principals would get swapped. Now I'm sure sometimes what I'm talking may not be clearly understandable and you might be already getting confused that, sir, what are you talking, only you are understanding, we are not. But don't worry my friends, this is a brilliant concept, a very beautiful concept. Let us try to crack it down, let us try to understand it very well. Now if you look at from where did this concept originated, so let me tell you one thing, this concept originated from basic human psychology. What kind of psychology I am talking about? See, human beings, how they are, you are also one of them. What we have, we don't like that. What we don't have, we are always aspiring about that, correct? You recollect during your childhood when you were school going students, you used to carry a tiffin box with you, and your mother would have prepared best of her recipes for you every day. You know, she would have tried to make some changes in your food menu on daily basis, and so that you get varieties. But you know what happens, your mother, maybe she is one of the best cooks, but you eating that same kind of food, having same kind of taste, you would want a change. So you always are keen on what is the tiffin box carried by your friend, what is your friend's tiffin box including, and you would want to taste that food, you would want to try that food, you would want to offer your tiffin box to your friend. So swapping of your tiffin boxes in your childhood gives an evidence to this human psychology. You are just willing to give away your tiffin box, you want your friend's tiffin box, and your friend also has same psychology. That is why the swap happens and both the friends are very happy because they got to taste some different food, some other food, and both are happy. So the point is, interest rate swap, this concept is emerging from the same human psychology, but of course here what is getting swapped is not a tiffin box but interest rate arrangement, and here you need to understand what could be this interest rate swap. Now if we talk about this concept in particular, that is why this swap would happen or for what reason someone would be willing to have a swap. Swap basically means you give away something and you take something in return. Swap means an exchange, you are exchanging something for the other. That is the simple meaning of the word swap. Now what is interest rate swap? Imagine that there is a borrower. A borrower, when you approach as a borrower to a bank would give you best deal in terms of interest rate. They will give you lowest possible interest rate, because at that point you are at a bargaining position. Because if that bank is not giving you best deal, you may go to the other bank. If not that other bank, yet third bank, there may be plenty of borrowing options for you. And therefore, bank also knowing this fact, you approaching bank asking for best deal, they will indeed offer you a best deal. Generally, there can be two types of interest rate arrangement: fixed rate and floating rate. Now, what is fixed rate? You will be borrowing at fixed rate, and interest rate once agreed upon won't change until your borrowings are fully repaid. That is a fixed rate borrowing. On the other side, floating rate, where there will be a base rate prevailing in any country. For example, you would have heard of repo rates, and RBI in India keeps changing these repo rates. These repo rates are kind of interbank offer rates, that is the rate at which one bank would borrow from other bank. And then these are interbank rates, and the bank would add its margin to quote an interest rate to the end customer who is the borrower. So when you borrow at a floating rate, when the floating rate base changes, your effective interest rate would also undergo a change. So for example, repo rate prevailing in India, suppose it is 4.5%, and the bank has taken a margin of 4%. So 4.5 plus 4, the quoted rate to the borrower by the bank would be 8.5% per annum. So when the repo rate changes from 4.5 to 4.75, the effective interest rate for the borrower will be changing from 8.5 to 8.75, assuming that bank continues to maintain that 4% margin. What we call as repo rate, technically it is identified as MIBOR, that is Mumbai Interbank Offer Rate. In India, the base of floating rate, which we generally refer to as a repo rate, it is Mumbai Interbank Offer Rate, MIBOR. When you talk about international markets, it is LIBOR, LIBOR, London Interbank Offer Rate. So there will be a floating rate base. On top of that, bank would add its margin and provide a quote to the customer. Now what happens? Suppose there is a borrower who has borrowed at a floating rate with an expectation that if the repo rate or the base rate or MIBOR declines, the borrower will be at an advantage of paying lower interest on the remaining part of the borrowings. After the borrowing has been initiated, once the borrowing has been made already at that floating rate, now the borrower feels some kind of risk. The borrower expects that what if the interest rate would start rising up unnecessarily because of the floating rate arrangement, the borrower will have to pay more and more amount of interest. And therefore, borrower sometimes may not be happy. Every time, suppose interest rate increases by 25 basis points, the borrower feels that pinch, because if it's a long-term loan and a big amount of loan, say housing loan or loan against property, big amount of loan, a little bit of change in the interest rate will increase the commitment of the borrower like anything. Now, borrower finds this risk only because the rate agreed upon was a floating rate. Now here the borrower thinks that what if the borrower would have originally borrowed at a fixed rate, then this kind of risk would not have happened. Borrower can approach the bank and ask for changing the interest structure, the interest arrangement on an overall basis. Bank is ready to offer a deal of fixed rate against a floating rate. That means you can change your interest rate arrangement. Let me tell you, changing the interest rate arrangement with your own bank is not called a swap. Okay, swap is something different which we have yet to understand. So bank will definitely be agreeing to change the interest rate arrangement from a floating rate which is existing to a fixed rate, but bank will not be giving you best deal, because now you have already borrowed from the bank. Now if you repay that, now if you early terminate that loan, or you go for arrangement or rearrangement or restructuring of that loan, bank is not going to give you best terms, because now you have already made a borrowing. bank will always try to take advantage of this situation by charging a little higher rate for changing the interest rate arrangement, and therefore you find yourself in a stuck situation. Imagine there is yet another party who has originally borrowed at a fixed rate. That party will be finding always an uncomfortable situation when interest rates in the market decline, because what will happen, interest rate in the market declines, repo rate declines, MIBOR declines, and everyone in the market who are paying interest on their borrowings at a lower rate, this person who is a borrower at fixed rate continues to pay interest at a higher rate. Isn't that giving you discomfort? Yes, it is giving you discomfort. You continue to pay at a higher rate where others are paying at a lower rate. This person now thinks that what if that person also would have borrowed at a floating rate right from the beginning, and this person also approaching its own bank. The bank says that yes, we are ready to give you an offer of a floating rate in place of this fixed rate, such and such will be your interest rate. The borrower understands the scenario that bank is trying to take undue advantage of this situation because borrowings have already been made. So do you know what is happening with these two borrowers? One who has borrowed at a floating rate now is willing to get the interest rate arrangement transformed to a fixed rate, and the other who has borrowed at fixed rate now willing to get the interest rate arrangement transformed to a floating rate. Now these two parties may not get best deals from their respective bankers. I explained you already. They can approach yet another bank which performs swap arrangement. So this kind of banks who perform swap arrangement, they are not separate kind of banks, they are just banks but performing interest rate swap arrangements as an intermediary. These banks, so called swap banks, will have a big database that there are so many borrowers who have borrowed at floating rate now willing to get converted into fixed rate, and there will be so many borrowers in their database who have borrowed at fixed rate willing to get converted into a floating rate, and these are not the borrowers of money from that swap bank. They would have borrowed from anywhere, correct? Swap bank is just going for a matchmaking, the right matchmaking. And for this purpose, if these two people would approach a swap bank like this, swap bank will try to make arrangement and look into whether a swap deal is workable or not. So do you know, in total, 3 parties get involved in an arrangement like this. What 3 parties are getting involved? The 2 borrowers, the primary borrowers which are willing to swap their interest rate arrangement, and the third party is the intermediary, that is a swap bank. So when this whole arrangement is observed by the swap bank will look into one thing, whether a swap deal is possible or not. If possible, and if it is benefiting, the benefit will be shared by all the 3 parties in some defined ratio. How this arrangement would work, how to compute that differential benefit, we are going to learn everything in detail. What I have done for this purpose, I have designed a very beautiful question over here, that is question number 17, and back to back 2 more connecting questions, that is question number 18 and 19. So you can consider question 17, question 18 and question 19 as if it's part of the same whole discussion, but these 3 questions are interconnected. And let me tell you one more thing, these 3 questions, I don't expect such big questions coming in exams, but my friends, my humble request to all of you, that in spite of lot of content given in these 3 questions and which are not so important from examination viewpoint, but if you want to handle examination questions with confidence and with complete clarity, my advice is follow the lead of these 3 questions back to back, and you will then understand that your complete clarity with respect to interest rate swap has already built. Then you can handle exam questions at click of your finger. So keep a lot of patience when I am taking you through these 3 questions. These 3 are very, very important questions from the viewpoint of your understanding. I told you very clearly that these questions may not be asked in exams as it is, because these are literally big descriptive kind of questions, but these are needed for building up that clarity. So let us do one thing. Let us first begin reading question number 17. Aditya has obtained a loan at a fixed rate of 13% from HSBC. He expects the interest rate to decline and is willing to take the benefit of declining interest rate. He wants to convert his loan into a floating rate. HSBC offers him floating rate of MIBOR plus 1.9%. Another party, Krishna, has borrowed from Citibank at floating rate of MIBOR plus 1.5%. He expects the interest rates to rise in future and this will increase his commitment towards interest expenses. He is therefore willing to convert his loans into fixed rate. Citibank offers him fixed rate of 14% per annum. Both these parties approach NJ Limited, that is a swap bank, to find out whether any swap deal can be effected and decide to swap their interest obligations, and the overall benefit of swap shall be shared by the three parties including the swap bank in the ratio of 5:5:4. You are required to determine whether interest rate swap deal can be effected, determine the differential surplus that benefits each of the three parties, show how the interest rate swap deal will be arranged, and show how each party is benefited from the swap deal. So friends, before we start solving this question, it is very important to understand the whole scenario. Let us first observe what is informed. So one of the party named Aditya has already borrowed from HSBC at 13% per annum fixed rate. Another party, Krishna, has borrowed from Citibank at MIBOR plus 1.5% floating rate. Now what happens? Aditya has already borrowed at fixed rate. When Aditya is asking its own bank to offer a floating rate arrangement, bank is now offering MIBOR plus 1.9%, correct? And likewise, if Krishna is asking his banker to offer a fixed rate, Krishna's bank, Citibank, is offering him 14% rate. So friends, it is very understand to identify what is the problem involved over here. When you approach any bank for the first time for borrowing money, you are a fresh new client, they would give you best deal. But when you have already borrowed and now when you go for changing your interest rate arrangement, bank will take advantage of that. You also know it that now you are not a new client for the bank, you have already borrowed money. Now you are asking the same bank to change your interest rate arrangement from a fixed rate to floating rate or vice versa. Obviously, bank will try to take advantage of this situation. Now you doubting this thing, you have now one chance available, that is to approach a bank or an intermediary which can arrange this kind of interest rate swap. That means you approach an entity that is arranging swap deals of interest rates and ask that bank whether something can be done. And that has what happened in this case, where these two parties, Aditya and Krishna, they have also approached a swap bank. And when they have approached a swap bank is required to analyze whether any swap deal can be arranged between these two parties, Aditya and Krishna. So we will look into whether a swap deal can be arranged or not. But first of all, what you do is this small presentation quickly note down so that it will give you a clear picture of what the question is asking you to do.
Alright, after understanding what is the scenario, now what you have to do, it is a very simple task. Please pay attention on something very important. This is the fixed rate of interest that Aditya is paying to his banker. This is the floating rate interest which Krishna is paying to his banker. Both of these rates are existing rates, right? You need to take in total, Aditya and Krishna taken together are paying how much interest to their respective banks on an aggregate basis. That means you are going to sum up the percentage of interest whatever they are paying to their respective banks, and then you have to take the aggregate of the revised arrangement that their bank have offered to them. That means you take aggregate of existing, you take aggregate of these revised and compare. If you find that revised arrangement offered is higher than the existing arrangement, that means their banks are trying to take advantage of the situation. You, however, will not let the bank take advantage. You straight away approach a swap bank and making sure that both of yours interest arrangement will be swapped, but you will end up paying overall lesser interest as compared to what your bank is now offering. So how to write up this as part of your answer, I am showing that. Please take note of the same. So what you would do is determining whether a swap deal can be effected. You would first take the existing aggregate of interest, that is 13 plus MIBOR plus 1.5, that will be MIBOR plus 14.5, and the revised aggregate offered by their banks, MIBOR plus 1.9 plus 14, and that will be MIBOR plus 15.9. Now you take revised minus existing. So revised minus existing would give you a differential of 1.4%, and that is a positive difference. That being a positive difference, you can conclude that a swap deal can be effected. So friends, I want you to do one thing, write up this first part of your solution and then we shall move ahead. Alright friends, you would have finished writing this. Let us now move ahead and calculate a simple thing. If the differential surplus of 1.4 is to be shared among the three parties, Aditya, Krishna and Swap Bank, in the ratio of 5:5:4, then the interest differential surplus of each will be, Aditya will be 1.4 into 5/14, and that is 0.5%. Similarly, Krishna's share would be 1.4 into 5/14, that is again 0.5%, and Swap Bank's share would be 1.4 into 4/14, and that will be 0.4%. See, simple thing is the overall differential benefit was positive 1.4%, and the three parties have agreed to share in the ratio of 5:5:4. So it goes for the three parties, their respective shares, 0.5%, 0.5% and 0.4% respectively for Aditya, Krishna and Swap Bank. So do one thing, write up this as a second part of your answer and then we shall move ahead.
Alright friends, once you have completed writing this part of the solution, let me take you ahead and please write the next heading, the most important part of the solution, that is arrangement of the swap deal. Write this heading, I am waiting for you. Alright friends, I am sure you have written this heading. Now look at one thing, that originally what was informed. Aditya, one of the borrower who has borrowed from its own bank at 13% fixed rate, and Aditya is currently paying interest of 13% to its own bank. Now what will swap bank first do? Swap bank will start a reimbursement of this 13% on a notional basis. So if you could see, the rate of interest that Aditya is paying to HSBC, because Aditya has borrowed from HSBC primarily. And why is swap bank providing a reimbursement? For the purpose of swap, what has to be done? Whatever interest payment Aditya is making to the HSBC bank should be swapped with a floating rate interest payment, correct? That is what you want to do. Aditya, who is a fixed rate borrower, should stop paying interest at fixed rate and start paying interest at the floating rate. Now what was the floating rate offered by HSBC bank, that is Aditya's own bank, to Aditya? What was the interest rate offered by them? It was M plus 1.9%. So swap bank has to definitely provide a better deal. Now if you can recollect, in the previous discussion we have found that the rate benefit that should come to Aditya's pocket was 50 basis point, or by percentage 0.5%, because the total differential surplus was 1.4%, which was divided among the four parties, and Aditya's share is 0.5%. So Aditya's own banker, that is HSBC bank, is offering Aditya M plus 1.9% floating rate. Swap bank has to offer little lower than that, and that lower than should be by 0.5%. So M plus 1.9 minus 0.5, swap bank must offer a floating rate of M plus 1.4% to Aditya. So what will happen? Aditya is paying a fixed rate of interest to its own bank, that is HSBC bank. First of all, what swap bank will do? Swap bank will say, okay fine Aditya, whatever money you borrowed from your bank, we will kind of re-borrow that money from you on a notional basis, and whatever interest you are paying over there, 13% of the principal amount, we will reimburse that 13% of that principal amount on a notional basis. So simple point is, whatever Aditya pays to HSBC bank, first of all on a notional basis, the swap bank will reimburse the same amount to Aditya. Now Aditya's interest expense got nullified, right? So now Aditya is required to pay interest at floating rate, and that to reduced floating rate of M plus 1.4%. So Aditya will now pay on notional basis to swap bank at M plus 1.4%. So when Aditya is receiving interest from swap bank on a notional basis, Aditya is paying interest to swap bank on a notional basis, both of those receipt payment will be set off, and the net amount which is either receivable by Aditya or payable by Aditya, that amount will be actually settled between the swap bank and Aditya on actual basis. So what I'll do is, to make you completely understand with this whole arrangement, let me take you further to this arrangement of the swap deal. So by far what we have learnt, Aditya pays to HSBC 13% and swap bank is making a reimbursement of that 13% on notional basis. Now Aditya's bank HSBC is offering him a floating rate of MIBOR plus 1.9%, this rate, correct? And Aditya doesn't want to borrow at this rate. Through swap deal, Aditya will be benefited by 0.5%. So from this rate, correct, from this rate,
you subtract 0.5% and that will give you MIBOR plus 1.4%, and that MIBOR plus 1.4% is the rate at which interest will be paid by Aditya to Swap Bank on a notional basis. So friends, if you observe the flow of interest, Aditya to HSBC, this was the actual interest payment of 13%. Aditya to Swap Bank and Swap Bank to Aditya, both of these are notional, but whatever be the difference between the two will be settled between Aditya and Swap Bank on actual basis. So friends, how that arrangement would work, we have solved that part little later, but first we are trying to observe the overall arrangement. So this left part of the swap arrangement is also known as the left leg or the fixed leg of the swap, correct? Let us now focus on the other leg, that is the floating leg, where the party involved is this other party, Krishna. Now Krishna has borrowed from Citibank at MIBOR plus 1.5%. Same way, the way Swap Bank has dealt with Aditya, Swap Bank will deal with Krishna also in the same way. Whatever interest Krishna has paid to Citibank, Swap Bank will first reimburse that on notional basis. Thereafter, whatever interest rate Citibank is offering to Krishna for a fixed basis, that is 14%, correct? Now, Swap Bank will offer Krishna a better rate. It is 0.5% less than this. That means it will be 13.5%. So it is 13.5% rate at which Krishna will pay to Swap Bank. So friends, we are going to write up this entire arrangement in complete explanatory format as well. But what I want you to first do is, I want you to note down this presentation so that it gives you a clear picture of what is going to happen by way of arrangement of a swap deal. So write this and then we move ahead. Alright friends, let us move ahead and now write up the entire description about Aditya first. The Swap Bank shall borrow from Aditya on notional basis at the same rate that Aditya pays to his bank, that is 13%. Thereby, Swap Bank shall reimburse the interest of the same amount to Aditya that he has paid to his bank. In turn, Aditya shall borrow from the Swap Bank on notional basis at an interest rate which is 0.5% lower than the rate offered by his bank, that is at the rate of MIBOR plus 1.4%. With this arrangement, Aditya could convert his fixed rate loan into a floating rate loan, that too at a lower rate. So friends, write down this whole thing and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and take Krishna's case. In case of Krishna, Swap Bank shall borrow from Krishna on notional basis at the same rate that Krishna pays to his bank, that is MIBOR plus 1.5%. Thereby, Swap Bank shall reimburse the interest of the same amount to Krishna that he has paid to his bank. In turn, Krishna shall borrow from Swap Bank on notional basis at an interest rate which is 0.5% lower than the rate offered by his bank, and that is at the rate of 13.5%. With this arrangement, Krishna could convert his floating rate loan into a fixed rate loan, that too at a lower rate. So write down this as well and then we move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and now take the case of Swap Bank. Now its interest income from both the sides on notional basis is 13.5% plus MIBOR plus 1.4%, and that would be MIBOR plus 14.9%, and its interest expense will be 13% plus MIBOR plus 1.5%, that is MIBOR plus 14.5%. By taking the difference, we can see that the differential surplus that the Swap Bank is earning is 0.4%. Quickly write up this part as well.
Alright friends, once you have completed writing this entire solution, let us move ahead, and now what we do is we take the connecting question, that is question number 18. Let us first read this question. It says, in question 17, assume that both Aditya and Krishna have borrowed from their respective banks an amount of rupees 1 crore each. For interest rate swap arrangement, consider a notional loan of rupees 1 crore. Determine the net payoff under both the legs for each of the following situations. Case 1, MIBOR equals to 9% per annum. Case 2, MIBOR equals to 13% per annum. So can you notice when we have been given these two cases, case 1 where the MIBOR is declining and case 2 where the MIBOR is rising up, and we have been given the complete information about the amount borrowed by each of the two parties, and the notional loan for the swap arrangement is also matching with the same. Now in this scenario where all calculations can be made in details at length, let us look into how to present the solution for better understanding of what we have learnt in question 17. Now we have much more information on a quantified basis. So let us just look into how to present the solution.
Case 1, MIBOR equals to 9%, and you first take the viewpoint of Aditya. So interest paid by Aditya to own bank will be 13% of 1 crore, that is 13 lakhs. Understand this thing. This will be the actual interest payment. Now, interest that Aditya receives from swap bank on a notional basis will be the same amount what he has paid to his bank. So 13 lakh paid, 13 lakh received, nullified, right? But this is on a notional basis. Not to worry. Now what happens? Interest that Aditya has to pay to swap bank on a notional basis will be MIBOR plus 1.4%. Correct? Now this 10.4 is nothing but MIBOR plus 1.4%. MIBOR being 9%, this is 9 plus 1.4, that is 10.4%, and that gives you the interest commitment on notional basis as 10,40,000. So interest received from swap bank on a notional basis is 13 lakh. Interest paid to swap bank on a notional basis is 10,40,000. The difference between these two notional values will be settled on actual basis, where we are concluding that Aditya will receive net from swap bank rupees 2,60,000. Now this amount actually swap bank will pay to Aditya. So finally, if you look from the viewpoint of Aditya, the actual cash flow number 1 was this, right? And the second actual cash flow is this amount. This was an outflow, this is an inflow. So we identify this as X, this as Y. X is outflow, Y is inflow. So interest cost on a net basis will be X minus Y, that is 10,40,000, and 10,40,000 is nothing but 10.4% of the loan amount, which is nothing but MIBOR plus 1.4%, which anyway Aditya wanted to incur. So by this arrangement, Aditya could swap his interest obligation of 13% to an interest obligation of 10.4%, which was actually indication of a floating rate. So friends, please carefully note down this whole thing, and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead. And what we do now is we continue with the case 1, that is MIBOR equal to 9%, but we take the viewpoint of the other party, that is Krishna. Now what Krishna has paid to his bank was MIBOR plus 1.5%. Understand one thing very well. MIBOR is 9%, so MIBOR plus 1.5% will be 9 plus 1.5, that is 10.5%. Now Krishna has paid to his bank on a floating rate basis, that is MIBOR plus 1.5%. What happens as an arrangement with swap bank? Krishna will receive from swap bank on notional basis as same amount what he has paid to his bank. So Krishna has received on notional basis an amount of 10,50,000 from swap bank, and now interest paid by Krishna to swap bank on a notional basis will be at a fixed rate. Fixed rate was 13.5%. So that will be 13,50,000. Now both of these amounts are notional, but their difference will be settled on actual basis. From viewpoint of Krishna, amount receivable on notional basis is 10,50,000. Amount payable on notional basis is more. It is 13,50,000. So the net difference is a payable amount. Therefore, Krishna will make a net payment to swap bank. This will be settled on actual basis. Now from viewpoint of Krishna, this amount was paid to his own banker, 10,50,000. This is the actual outflow. This amount is paid to swap bank. This is also an actual outflow. So both of these are actual outflows. We mark them as X and Y. So interest cost will be basically X plus Y in this case, and that comes to 13,50,000. And that 13,50,000 is nothing but 13.5% of the loan. Krishna wanted a fixed rate of 13.5%. Finally, Krishna is still paying 13.5% of this interest. Now, before you start writing this, I want you to make one more careful observation. Do you see Krishna paid to swap bank a net amount of 3 lakhs? On the other side, Aditya received from swap bank a net amount of 2,60,000. The previous working, right? The case of Aditya received from swap bank 2,60,000, whereas Krishna has paid to swap bank rupees 3 lakhs. That difference between 3 lakhs and 2,60,000 is the net surplus that is lying with the swap bank as its share of this arrangement, and that is 40,000. And 40,000, when you relate with 1 crore, it is nothing but 0.4%, because swap bank had its share as 0.4% in this entire arrangement. So do one thing, write up this whole thing, and then we move to second case. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up case 2 where MIBOR is 13% per annum, and now we are taking the viewpoint of Aditya. Now Aditya has paid to his bank 13% fixed rate. This is already known. Aditya will get a reimbursement on a notional basis of the same amount from swap bank, that also we know. Now under the interest rate swap arrangement, the rate at which Aditya should pay interest on a notional basis would be MIBOR plus 1.4%, and that will be 13 plus 1.4%, and that is 14.4%. So what will happen? Aditya would receive on notional basis an amount of 13 lakh and will have to pay on a notional basis 14 lakh 40,000. The differential between these two amounts on a net basis, Aditya will have to pay to swap bank, and therefore this is an actual outflow. Even this differential will now be an actual outflow. Both these are outflow. We are marking these as X and Y. So your interest cost for Aditya this time will be 14 lakh 40,000, and that is 14.4% of the loan amount. And you cannot help it now because MIBOR itself is 13% and you have agreed to pay 1.4% more than the prevailing MIBOR. So prevailing MIBOR is 13. You would pay interest at 1.4% more than 13, that is 14.4%. And finally, what Aditya wanted was payment of interest on a floating basis, and finally he could arrange his fixed rate loan into a floating rate loan. So do one thing friends, quickly write up what you are finding on screen and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us now continue with the second case, but now viewpoint of Krishna would be taken. So Krishna has paid to interest at 14.5% to his own banker. How we got 14.5%? It is MIBOR plus 1.5%, and MIBOR being 13% in this case, the interest paid by Krishna to his banker will be 14.5%. That is 13 plus 1.5%. So now whatever Krishna has paid to his bank, now Krishna is entitled to receive reimbursement on notional basis of the same amount from swap bank, and in turn Krishna has to pay interest at a fixed rate of 13.5% to swap bank as agreed. So finally, on a notional basis, Krishna will be entitled to receive 14,50,000 and would be required to pay 13,50,000. Therefore, these two notional amounts, when settled on actual basis, the net differential will be settled on actual basis. That will be net receipt in the hand of Krishna from swap bank. So on a net basis, Krishna is to receive from swap bank a net amount of rupees 1 lakh. Finally, what we observe is this is an interest payment which is an outflow. On the other side, this Y, what we have marked as an inflow, the interest cost on a net basis will be X minus Y. That will be 14,50,000 minus 1 lakh, that is 13,50,000, which stands at 13.5% of loan, which anyway Krishna wanted to pay. So friends, note down this whole thing and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us now once again observe from the beginning, the conclusion what we have drawn. First taking the case 1, that is viewpoint of Aditya, where MIBOR is 9% Aditya has received net from Swap Bank as 2,60,000. In the same case, Krishna has paid to Swap Bank 3 lakhs. So what is happening? Observe, Krishna pays to Swap Bank 3 lakhs, and on the other side Aditya receives from Swap Bank just 2,60,000. The differential of 40,000 is retained by the Swap Bank itself. What happens in case 2? In case 2, Aditya pays to Swap Bank on a net basis 1,40,000, whereas Krishna receives on a net basis just rupees 1 lakh. Again, difference between 1,40,000 and 1 lakh is now retained by the Swap Bank on net basis. So every time Swap Bank is retaining differential of 40,000 rupees, that is nothing but 0.4% of the notional loan, that is 0.4% of 1 crore, and that is Swap Bank's share of this entire arrangement. So friends, with that we put an end to that particular question. Let us move ahead and write down some important points, very important points. If a borrower who has borrowed at fixed rate expects that interest rate will rise, then the borrower would want to continue with the existing interest rate arrangement. In case the borrower expects the interest rates to fall, the borrower will be better off by swapping his existing arrangement against a floating rate loan. On the other side, if the borrower has borrowed at a floating rate and expects the interest rate to fall, then the borrower would want to continue with the existing interest rate arrangement. If the borrower expects the interest rate to rise, he will be better off by swapping his floating rate loan into a fixed rate. Now friends, I am giving you time, note down these important points. Alright friends, you would have finished writing this whole thing. Let us write up one more thing. Reverse will be the case of investor with respect to note number 1 and 2 above. Just write one line because we don't want to repeat those words again and again. So it will be reverse case for the investor. Quickly write this line.
Alright friends, once you have completed writing this note as well, let us move ahead and now take up the next connecting question, that is question number 19. Let us read this question. It says, in question 17, if the swap bank is not involved as the intermediary, then Aditya and Krishna could have shared the overall benefit of 1.4% just between two of them. How would you arrange a swap deal in such a case where Aditya and Krishna decide to share the net differential equally without involving NJ Limited, that is the swap bank, as an intermediary? Explain how the interest rate swap deal will be arranged. Also specify the benefit flowing to each party. Consider the notional amount of loan as rupees 20 lakhs and MIBOR equals to 11.5%. Specify how much differential will be settled between the two parties by end of the year. So before we start approaching the solution, let us first try to understand what exactly is given over here. So when swap bank was involved as an intermediary, what happens? These two parties are kind of paying their share of profits also to swap bank, because someone as an intermediary would definitely also place some charge. So what if the intermediary gets absent from the picture? If the intermediary is removed from the picture, obviously both the parties would be getting more share of their differential benefit. So 1.4% was the overall differential benefit. If the two parties share it equally, it will be 0.7% and 0.7%. But how would you make this happen? Very simple. Here you have to consider any one party as the base. If I consider Aditya as the base, Aditya pays 13% to HSBC Bank. First of all, Krishna should reimbursement that 13% on notional basis, and Aditya should pay back to Krishna at a floating rate. What should be the floating rate? Aditya's banker has offered M plus 1.9, but differential benefit to Aditya on this new arrangement where swap bank is not involved is 0.7%. So Aditya should bear interest cost of M plus 1.9 minus 0.7, that will be M plus 1.2. So what will happen? Aditya pays 13% fixed rate of interest to its own bank, that is HSBC Bank. Krishna will first reimburse that 13% on a notional basis, and then Krishna will recover from Aditya M plus 1.2%. So Aditya's matter has been taken care of. You would then see Krishna's part of the story. Automatically the Krishna's story would give you that simple highlight about what differential benefit eventually Krishna is getting. We can definitely make it reconciled. Of course, if you just take care of one party, the whole remaining benefit will be obviously flowing to the other party. So let us look into how to present the solution over here.
In this case, Aditya first pays interest to his bank at fixed rate of 13%. What will Krishna do? Krishna will reimburse to Aditya the same interest of 13% at fixed rate. From the other angle, that is from the viewpoint of Krishna, if you see, Krishna is paying to his bank at MIBOR plus 1.5%, and what Aditya will do, Aditya will pay to Krishna in return as MIBOR plus 1.2%. So be very clear how we got all these arrangements. This 13% was already known. Krishna's reimbursement to Aditya is matching with this 13%. This is clear, right? Likewise, Krishna paying to Citibank MIBOR plus 1.5%, even that was known. This is known, this is known. This is a reimbursement that would match with the interest what Aditya is paying. Just you have to focus on this rate. This rate is basically MIBOR plus 1.9% what HSBC Bank offered to Aditya, and from MIBOR plus 1.9% you have subtracted 0.7%, and that gives you MIBOR plus 1.2%. Through this arrangement, both the parties will get their target achieved. Both the parties will be able to swap their interest rate arrangements with a mutual benefit of 0.7% each. So do one thing, write up this arrangement and then we will make a descriptive note of the same. Alright friends, let us move ahead and write up the descriptive details of this arrangement. We would say that in this arrangement, Krishna shall reborrow from Aditya on notional basis at the same rate that Aditya pays to his bank, that is 13%. Thereby, Krishna shall reimburse the interest of the same amount to Aditya that he has paid to his bank. In turn, Aditya shall reborrow from Krishna on notional basis at an interest rate which is 0.7% lower than the rate offered by his bank, that is MIBOR plus 1.2%. Quickly write up this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and write up more. We would say with this arrangement, Aditya could convert his fixed rate loan into a floating rate loan and Krishna could convert his floating rate loan into a fixed rate loan. That too at lower rates as compared to what was offered by their respective banks. So we have taken the whole basis of Aditya. So let us also look from the viewpoint of Krishna. Net expenses of Krishna towards interest would be 13 plus M plus 1.5% minus M plus 1.2%. Now let us try to understand this. 13 is the reimbursement made by Krishna to Aditya. M plus 1.5% is what Krishna pays to his own bank, and M plus 1.2% is the reimbursement that Krishna got from Aditya. This is on a net basis working to 13.3%. This is the target interest rate of Krishna. Why? Because Krishna's bank has offered him 14% fixed rate, and if you subtract 0.7% from 14%, what you would get is exactly 13.3%. So do one thing, write up this whole thing, and that will be Krishna's viewpoint as well included over here, and then we shall move ahead with the later part of the question. Alright friends, you would have finished writing this part as well. Let us move ahead and write the last part of the solution, where it is given that the notional loan amount is rupees 20 lakhs and MIBOR is 11.5%. What would be the net result in that case? So what would happen? You first work out the interest rate of both the parties without swap. If there was no swap, then Aditya would have paid to his bank 13% of 20 lakhs, that is 2,60,000, and Krishna would have paid MIBOR plus 1.5%, that is 11.5 plus 1.5%, and that would be nothing but 13%, correct? And that will also work out to 2,60,000. That means if there was no swap arrangement, both the parties would have paid to their respective banks 2,60,000. Here with the swap arrangement, Aditya's obligation is only 2,54,000. Why? Aditya's obligation is MIBOR plus 1.2%. MIBOR is 11.5%. 11.5 plus 1.2 gives you 12.7%. 12.7% of 20 lakhs would give you exactly 2,54,000. And Krishna's expense with swap would be 13.3% of 20 lakhs, that will be 2,66,000. So when you find the net gain or loss, Aditya's obligation without swap was more, with swap it is less. So Aditya got benefit because of swap, that is by 6,000, and Krishna lost the same amount, rupees 6,000. So eventually Krishna will pay to Aditya on the settlement, that is a sum of rupees 6,000. So please take note of this whole thing, and that will be end of the solution.
Alright friends, once you have completed writing this entire solution, let us move ahead and take up another question, that is question number 20. Little different question, let us read it. Strong Limited, having very good credit rating, is offered by its bank a fixed rate of 12% per annum or floating rate of M plus 1%. This company wants fixed rate. Weak Limited, having very poor credit rating, is offered by its bank a fixed rate of 13% per annum or a floating rate of M plus 1.5%. This company wants floating rate. Verify whether a swap deal can be effected. Now when we read this question, we get some confusions in our minds. Confusion number one, none of these parties are informed to be as borrowers or investors. How do you identify whether these two parties, these two companies, Strong Limited and Weak Limited, are they borrowers or are they investors? Are they willing to borrow money or are they willing to invest money? Because they have simply informed you the interest rate offered by this bank. And understand one point, if you are not clear with whether the two parties which are intending to involve in a swap arrangement, are they investors or are they borrowers, you cannot even think of a swap deal. So let me clarify this point. See, your understanding about how you read and interpret the question is why so important. Look at one point in the question. The question informs you the credit rating of the two companies. Bank has offered them interest rate based on their credit rating. When will bank consider someone's credit rating? Imagine if I want to approach a bank and I want to deposit money with bank, bank has nothing to do with my credit rating, correct? Because bank will consider credit rating of the customer only when the customer is approaching for the purpose of borrowing. Because the bank has offered interest rate based on the respective credit rating of the two companies, it is implied that both these companies, Strong Limited and Weak Limited, are definitely borrowers. They are not investors, they are not lending money to bank, they are not investing money with bank, they are just borrowers. One confusion clarified, correct? I'm sure you are clear that both of these companies are borrowers. Second point is, in all the questions that we have seen earlier, the two parties which are involving themselves in a swap arrangement or in a swap deal are already existing borrowers. Here, Strong Limited and Weak Limited have yet to borrow. They are not yet borrowers. So, planning a swap or not planning a swap itself is a decision making choice over here. So, try understanding one thing. Strong Limited is a company that wants to borrow at a fixed rate. Its bank has offered both the rates, fixed rate as well as floating rate. So, if Strong Limited directly borrows from its bank at fixed rate and fixed rate arrangement is what it wants, then there will be no swap happening. Alternatively, what Strong Limited can do, it can borrow at a floating rate and simultaneously ask Weak Limited to borrow from its bank at a fixed rate, and then Strong and Weak Limited, both of these companies, can swap their interest arrangements. So we can figure out that there will be two alternatives available with the company Strong Limited. First alternative, that was without swap. Second alternative is with swap. Now let us look into the other party, that is Weak Limited. Now Weak Limited wants to borrow at floating rate. So Weak Limited also has two alternatives. It can borrow from its bank directly at a floating rate where swap will not happen, or it can borrow from its bank at a fixed rate and then it can swap the fixed rate arrangement with a floating rate with Strong Limited. So in the first alternative for Weak Limited, there was no swap. In the second alternative, swap is involved. So we have both the parties with two different alternatives. So what we will do is, we will first look into what if they borrow from their own banks their desired arrangement, that is Strong Limited borrows at fixed rate, Weak Limited borrows at floating rate, absolutely no swap happening, they are happy with their own banks. Look at how much aggregate interest payment they are making. Aggregate is important because both taken together, how much interest they are paying. That is one aspect. Then you look into that what if Strong borrows at a floating rate, Weak borrows at fixed rate, and then they swap. In that case, it's a swap deal, and look into how much total interest payment you are making. So total amount of interest commitment with swap will then be compared with the total amount of interest commitment without swap, and whatever is more beneficial, that will be considered, and that is how you are going to arrive at whether a swap deal can be effected or cannot be. So that whole thing depends upon the aggregate. So keep in mind one thing, determine the aggregate interest commitment for both the companies taken together in case where there is no swap, and in case when a swap deal is arranged, look into what is better for both taken together. Whatever is better, go with that, and that is how you are going to arrive at the conclusion whether swap deal can be effected or not. So in terms of how to present your solution, just look into what I am showing over here. In the solution, we would first take the case of Strong Limited. This company desires a fixed rate loan. It has two different options. Option 1, borrow at 12% per annum fixed rate directly from own bank. That will be an arrangement without swap. And option 2, borrow from own bank at a floating rate of M plus 1% and then swap the same with Weak Limited for fixed rate. So this arrangement will be with swap. So do one thing, write up this much and then I take you ahead.
Alright friends, you would have finished writing this. Let us move ahead and look at the case of Week Limited. Now Week Limited, this company desires a floating rate loan. It has two different options. Option 1, borrow from own bank at a floating rate of M plus 1.5%. So this will be an arrangement without swap. And the other thing could be option 2, borrow from own bank at a fixed rate of 13% per annum and swap the same with Strong Limited against a floating rate, and therefore this arrangement will be with swap. So friends, write this also, and then we start comparing and identifying whether a swap deal will be beneficial or not. First write this much. Alright friends, you would have finished writing this much. Let us move ahead and finally take the overall comparison on aggregate basis, determining whether swap deal can be effected. So aggregate interest rate that both the companies would be paying to their banks would be aggregate of both the interest rates without swap. So from Strong Limited, whatever was interest rate without swap, from Week Limited, whatever was interest rate without swap, that we have aggregated, and that comes to M plus 13.5%. Likewise, we take the aggregate interest rate with swap, that means Strong Limited interest rate with swap and Weak Limited interest rate with swap aggregated. And now we would compare. Without swap, it is M plus 13.5. With swap, it is M plus 14. And here you are borrower, you will have to pay interest. You would want to pay interest, lesser and lesser possible interest, right? That means between the two, what appears to be more economical? Obviously M plus 13.5, which is without swap. So we would conclude that the aggregate interest with swap is higher than the aggregate interest without swap. Therefore, a swap deal is not advisable. So what is the concluding point? Both the parties are recommended to borrow from their own respective banks at their desired interest arrangements. So friends, write down this as well, and that will be end of the solution.
Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, which is a connecting question, that is question number 21. Let us first read this question. It says, what will be your answer to question 20 if strong limited desires a floating interest rate whereas weak limited desires fixed interest rate? So basically we find that the objective of the two companies have completely got reversed over here, and in question 20 where we observed that a swap deal may not be affected or a swap deal was not possible at all, here we will definitely find a reverse scenario. So definitely the swap deal is beneficial. Let us look into how to present the solution over here.
Strong limited. This company now desires borrowing at floating rate. It has two different options. Option 1, borrow from own bank at a floating rate of M plus 1%, so that will be without swap. And second is borrow from own bank at 12% per annum, that is fixed rate, and swap the same with weak limited against a floating rate. So do one thing friends, write up this much and then we move ahead. Alright friends, you would have finished writing this much. Let us move ahead and take the case of weak limited. So for weak limited, we would say this company desires a fixed rate borrowing. It has two different options. Borrow from own bank at fixed rate of 13% per annum, that would be without swap. And second option is borrow from own bank at floating rate of M plus 1.5% and then swap the same with strong limited, that will be with swap arrangement. So do one thing again, write up this much and then we move ahead. Alright friends, you would have finished writing this as well. Let us move ahead and now conclude by comparing. So determining whether a swap deal can be effected. Aggregate interest rate without swap would be M plus 14% this time. Aggregate interest rate with swap will be M plus 13.5%. So now we see that with swap it is more economical. So we would conclude that the aggregate interest rate with swap is lower than that without swap. Therefore swap will be beneficial. As a result, both the parties should borrow from their respective banks at interest rate arrangement that is opposite of what they require, and then enter into a swap deal for respective benefit. So do one thing friends, write up this whole thing, and that will be end of the solution.
Alright friends, once you have completed writing this entire solution, let us move ahead and now take up concept number 11 for discussion. That will be speculative interest rate swaps. By far everything that you have learnt under interest rate swap was more of an approach for protecting a party for adverse interest movements. What about where there is no borrowing or investing involved and a party simply wants to speculate on the interest rate movements? So it is definitely very simple. Can speculation be done through interest rate swaps? The answer is definitely yes, it can be done, and this is again a wonderfully interesting area. Try to understand here, the two parties involved in the swap would not have any borrowings or investments at all. They have just tried to make up a deal for purely speculative purpose. So how can someone speculate with interest rate movements using swap arrangement? So we have seen speculation through FRA, we have seen speculation through interest rate futures and interest rate options as well. But what about speculation through interest rate swap? Simple thing, if you are a speculator, you can either have an expectation that interest rates would rise, or you may have expectations that interest rate would fall. Imagine you as a speculator, you are expecting the interest rates to rise. So in the coming time the interest rate would rise. So what would you prefer doing at rising interest rates? Would you prefer receiving interest at rising interest rate or paying interest at rising interest rate? Obviously you will prefer receiving interest at rising interest rate, and as and when interest rate rises, and if you want to take that advantage by receiving interest, you should be a floating rate receiver, means you should agree to receive interest at a floating rate, and in swap arrangement then you pay interest at fixed rate. So you become a fixed rate payer and floating rate receiver. Inversely, suppose your expectation is that the interest rate would fall and you would want to take the advantage of falling interest rate. First of all, think and tell me, with the falling of interest rate, would you want to receive interest at falling rates or would you want to pay interest at falling rates? I will say pay interest at falling rates. That means you become a floating rate payer, and in swap arrangement, when you pay at floating rate, you start receiving at fixed rate. So when the interest rates are declining, you become a floating rate payer and fixed rate receiver. So to summarize the whole thing, if you are willing to speculate and you are expecting that interest rates would rise, you want to use interest rate swap arrangement for making a benefit to yourself, you being a speculator and expecting that interest rate would rise, you become a floating rate receiver and fixed rate payer. If you expect interest rate would fall, take the reverse strategy, that is become a floating rate payer and fixed rate receiver. So this is how speculative interest rate swap would be arranged. So let me give you some notes on this and then we can move ahead. So first of all, write this point. If the speculator expects interest rates to rise, he will prefer receiving interest at floating rate and paying interest at fixed rate. So floating rate receiver and fixed rate payer. If the speculator expects interest rates to fall, he will prefer receiving interest at fixed rate and paying interest at floating rate, that is fixed rate receiver and floating rate payer. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and take up a question for understanding speculative interest rate swaps. That will be question number 22. Let us read this question.
Mr. Sunny expects interest rates to rise. Mr. Hitesh expects interest rates to fall. They enter into a swap deal whereby Mr. Sunny becomes floating rate receiver at MIBOR flat and payer at fixed rate of 10.5% per annum. Notional loan amount is rupees 5 crores and contract period is 1 year. Determine the net payoff at both the legs under the following cases. Case 1 given MIBOR equals to 8.92% per annum. Case 2 given MIBOR equals to 12.16% per annum. So friends, as I have explained, exactly same is the scenario that we find in this given case. You see, Mr. Sunny is expecting the interest rates to rise, correct? So he would prefer receiving interest at the floating rate, and that is what is given over here. Mr. Sunny becomes a floating rate receiver at MIBOR flat. When I say MIBOR flat, it will be pure MIBOR, no adjustments, no interests added or subtracted from MIBOR rate, absolutely flat MIBOR. In other words, no basis points will be added or subtracted from MIBOR. Now, notional loan is given as 5 crore. If you see, if the question is giving the viewpoint of Mr. Sunny that he becomes a floating rate receiver and fixed rate payer, obviously the counterparty Mr. Hitesh would have the reverse scenario, correct? Now let us do one thing. Let us see how to present the solution, and because the question has been drafted from the viewpoint of Mr. Sunny, we would draft the solution also from the viewpoint of that same party. So let us see how to present the solution. Case 1, Mr. Sunny, fixed rate payer and floating rate receiver. So what you would do? You would first look into how much interest this party would receive. So case 1, the MIBOR is given as 8.92%. So interest received from Mr. Hitesh will be 8.92% of 5 crores, that is rupees 44,60,000. And now interest paid to Mr. Hitesh will be at a fixed rate of 10.5%, and that comes to 52,50,000. So Mr. Sunny is entitled to receive 44,60,000 and required to pay 52,50,000. Now both of these amounts are to be received and paid on a notional basis. That means these parties are not going to actually receive and pay these amounts. These are notional values. However, difference between these two, either positive or negative value, will be paid or received by these parties on actual basis. So net difference paid to Mr. Hitesh, if you can see, the amount payable is more than the amount receivable, so the net difference will be paid by Mr. Sunny to Mr. Hitesh, and this difference will be the actual amount paid. So do one thing friends, write down this much and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the second case. Case 2. Here the MIBOR is little higher, right? So whoever is a floating rate receiver is going to be at an advantage, which in this case is Mr. Sunny. So let us see what happens. The interest received will now be at the MIBOR rate, that is 12.16%. So what we can see, the amount receivable increases substantially as compared to what we have seen in case 1. Now the interest paid to Mr. Hitesh will remain same, right? Because this party, Mr. Sunny, is a fixed rate payer. He has agreed to pay interest at fixed rate of 10.5%. So that amount of 52,50,000, this amount will not change whether it is case 1 or case 2. This amount however changes, and the net differential this time would be positive inflow for Mr. Sunny because amount receivable is more than the amount payable. So the net difference received from Mr. Hitesh will be 8,30,000. Now one thing you should never forget, that this amount of interest to be received and this amount of interest to be paid, both are receivable and payable on a notional basis. However, their difference is settled on actual cash payment. So at end of the period, the net difference that Mr. Sunny would receive from Mr. Hitesh would be 8,30,000. So friends, take note of this as well, and that will be end of the solution. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question. That will be question number 23. A question that has been repeated in exams quite a lot of times. Let us read this question. A dealer quotes all-in cost for a generic swap at 8% against 6-month LIBOR flat if the notional principal amount of swap is rupees 6 lakhs. Calculate semi-annual fixed payment. Second thing what they have asked is find the first floating rate payment for one above if the 6-month period from the effective date of swap to the settlement date comprises of 181 days and the corresponding LIBOR was 6% on the effective date of swap. Third part says in 2 above, if the settlement is on net basis, how much the fixed rate payer would pay to the floating rate payer. And the last line says generic swap is based on 30/360 days. So friends, how to interpret this line? They want you to consider 30 days in a month and they want you to consider 360 days in a year. So let us see how to present the solution. Very simple. First of all, the semi-annual fixed payment will be worked out. Notional amount of principal is 6 lakhs, fixed rate is 8%, and it is semi-annual means half yearly calculation. So it is 6 by 12, that comes to 24,000. Now the floating rate payment would be same notional value, that is 6 lakhs, but now the floating rate will be LIBOR, which is 6%, and the number of days to be considered will be 181 days. In the denominator we have taken 360 days, exactly as per the instruction given in the question. This works out to 18,100. So obviously both of these will be notional values, and the settlement will be on the basis of the difference of these two amounts, and that will be settled on a net basis. So if the settlement is on net basis, the net differential paid by fixed rate payer to floating rate payer will be how much? 24,000 minus 18,100, and that will be rupees 5,900. So friends, please take note of this whole thing, and that will be end of the solution.
Alright friends, once you have completed writing this entire solution, let us move ahead and now take up the next concept, that is concept number 12, overnight index swaps. So please write this concept heading in your notebooks, and I'll be explaining you the whole concept of overnight index swap, not just like that, but through an example, which is a very good question given in your textbook as question number 25. Let us first read that question. So before we start approaching the solution, let me first explain what exactly has to be done over here. You know what happens in an overnight index swap? Overnight means every day at the closing time of the market, whatever be the prevailing MIBOR for that particular day, that will be considered, and the interest will be accumulated on the previous day's balance as per that rate. For example, if you are calculating the interest for say Wednesday, you will take the Tuesday's closing balance. On that you will compute interest at the MIBOR rate which is applicable for Wednesday, add that interest to the opening balance, and you will get the closing balance for Wednesday. In other words, from day one when you have entered into this overnight index swap, the interest computed for each day will be added to the principal amount or to the opening balance, and gradually the balance will start accumulating. Take care of one thing. They have mentioned over here that Sunday is a holiday. If Sunday is a holiday, that doesn't mean that you don't compute interest for Sunday. You are also eligible to earn interest on a non-working day. However, because Sunday is a holiday and market will be closed, there will be no new rate announced on Sunday. So, how would you make the calculation? The last announced rate would have been the rate of Saturday. So, consider Saturday's rate for computing interest for 2 days, that is Saturday and Sunday. So, for each day earlier you have to add interest on daily basis, but when it comes to Saturday, consider Saturday's rate and compute interest for 2 days, and that 2 days of interest when computed, it will be added to the opening balance, and then you will arrive at the balance finally as of the beginning balance of Monday, because Saturday and Sunday 2 days of interest will be added together. That becomes Monday's opening balance, on which the Monday's MIBOR rate will be applied. Now this time they have not asked you the differential amount. They have already given in the question that the differential amount, that is a benefit, is 317. So what you always do, you compute interest under both the legs, floating leg and fixed leg, and then you find the differential. Here floating rate interest calculation can be done on daily basis through the overnight index swap rates given, that is MIBOR rates given for all these days of contract. However, fixed rate is not informed in the question. So fixed amount of interest what can be computed on that notional principal cannot be known. However, you know the amount which you will be considering under floating leg, and you find a notional amount under fixed leg, compare the two, you find the differential. Here the differential amount is given, and floating leg payments you can compute. The cumulative balance under floating leg adjusted with the settlement gain, you will get the total amount of interest under the fixed leg. Based on that amount of interest and the notional principal, you find out what would be that fixed rate, and that is how you are going to solve the question. So let me show you how to present the solution, and of course while presenting the solution I'll give all the necessary explanation as required.
In the solution, you would calculate interest under both the legs. So let us first compute the floating rate based interest. That means first we will calculate all the interest under the floating rate basis. So we begin with the first day, because you have entered into the contract on Monday and your interest calculation begins from Tuesday. The rate applicable for Tuesday is given as 7.75%. Notional balance at the beginning of the day was 10 crores. So now what you do, please pay attention on this calculation. Take 10 crores into 7.75% and consider 1 day's interest calculation. So that will be 1 by 365. That time factor you would multiply. So in other words, it will be 10 crores into 7.75% into 1 by 365 would give you interest of 21,233. Now this amount will be added to the notional balance or to the principal amount the next day. So Wednesday the rate declared is 8.15%, and the notional balance now would be revised to 10 crore 21,233. On this you apply 8.15% into 1 by 365, and that will give you interest of 22,334. Now this will be added to this existing balance. So the amount goes on getting accumulated with every day's interest earnings. So Thursday the rate is 8.12%, and that 8.12% will be applied, of course, on what balance? It will be this balance plus the interest earned in the previous day. So the opening balance of Thursday would be 10 crore 43,567. On this amount you are going to apply 8.12% again into 1 by 365. That will give you interest of 22,256. Next will be Friday. Friday's rate is 7.95%. Friday's balance will be previous day's balance plus the interest earned in the previous day. That will be 10 crore 65,823. On that, you would apply 7.95% into 1 by 365. That gives you 21,795. Never forget, after Friday, next day will be Saturday, and whatever rate is declared on Saturday, based on that you are going to compute interest for 2 days, that is Saturday and Sunday, and that rate is given as 7.98%. The opening balance on Saturday was 10 crore 87,618. Now be careful that you have to apply interest calculation for 2 days. So what you would do now is this amount into 7.98% into 2 by 365, and that would give you 43,764 as the combined interest income for 2 days, that is Saturday and Sunday. The last day would be Monday. Monday's rate is given as 8.15%, and the notional balance on Monday morning would be 10 crore 1,31,382. That is this amount plus this amount. So now on this final amount you apply 8.15% and again into 1 by 365. That will give you interest for that one day 22,358. When you total up the interest, what you get is the total interest receivable at the floating rate, and that is 1,53,740. We don't know how much is the interest under the fixed leg. However, we know one thing, that the net differential is received, correct? When the net differential is received, what does that imply? That the receivable must be more than the payable, correct? That means payable is less and receivable is more. To arrive at that less amount, we would subtract that net differential received. So 317 is the net differential received, and finally the interest payable under fixed leg would be this amount of interest under floating leg minus the differential of 317. This will be 1,53,423. Friends, till earlier question, what you had been doing, try to recall. You were computing interest under floating leg, you were computing interest under fixed leg, and the differential was settled on a net basis. This time you have arrived at the amount of interest under the floating leg. You already know the amount of net settlement received, and this time the interest under fixed leg was determined at the end like this. So friends, make sure that you just don't copy everything. I am giving you little additional time to write down everything. Please carefully make calculations, check every calculation, and then note down the whole solution. I don't want the copy business. Please write everything systematically with all calculations, making sure that you don't have any point of doubt over here. So write it up and then we shall move ahead. Alright friends, you would have finished writing this as well. Now one small formality needed, that interest what was computed under fixed leg, we have to arrive at the rate of interest. So the rate of interest will be based on the fixed rate which will be applied on the principal. So the calculation becomes very simple. So your interest payment will be divided by the principal amount of 10 crores into 100 for percentage, and that will be multiplied by 365 by 7, and that gives you 8% per annum approximately. So let me explain this calculation once again. This is the total amount of interest under the fixed leg. This is the notional principal. So whatever you calculate will be the interest, and if you would want to express that in percentage, you have multiplied by 100. So this is the interest rate, but that is for the 7 days. So we would want the annualization. So we have multiplied by the time factor of 365 by 7, and you may check the calculation. What you get is approximately 8% per annum. So friends, note down this whole thing, and that will be end of the solution.